Welcome, I'm Doug Diamond. I want to talk to you today a little bit about the regulation of the liquidity in the short-term debt financed part of the financial system, sort of banks, shadow banks, things like that. This is based on some research, some policy-oriented research that I've done with Anil Kashyap, also of Chicago Booth. And we have a couple of papers. There's one coming out in Handbook of Macroeconomics that sort of is the basis for this talk. And there's this idea here why the last taxicab must never leave the train station. That's sort of a fundamental confusion or paradox in thinking about regulating liquidity. I'll focus on that aspect of our work, but I'll also talk to some extent about how to think about why, in the first place, one would think that you would need to regulate the amount of liquid assets that the financial system held or banks in the financial system held. Okay, so there's been a bunch of regulation of the financial system recently. Basel III was sort of this international agreement among central banks on ways that regulation would evolve. A lot of the controversy recently, if you followed it in the press, has been about the level of bank capital, the amount of equity that banks have to have as part of their liability structure. And there's been a lot of argument there. At the same time, I'll talk about two types of things that got regulated. On the asset side of the banks, what type of assets they're allowed to hold. And there are a couple of requirements in this Basel III thing. That banks around the world have to hold a certain amount of liquidity on their asset side of their balance sheet. And there's a link between their assets and liabilities. I'll talk about these in a second. So the question is, why might you need to regulate this stuff? What's the question to which liquidity regulation is the answer? And you'd think if we just did all of this regulation in the last 7 years or so, there would be like a well-accepted question to which this regulation was the answer. And surprisingly enough, there really isn't. There wasn't much agreement or research or consensus on what's the reason that you need to regulate this stuff in the first place. And in contrast to regulating what kind of liabilities, capital, equity versus deposits, say, banks have, where there's at least something like Modigliani-Miller that says, hey, it really doesn't matter under certain circumstances, and you can think about removing those certain circumstances where it doesn't matter to think about why you might have to regulate the liabilities of banks, say because there's deposit insurance or something like that. But for the assets, for liquidity regulation, there isn't very much. In fact, there's a little survey written by Professor Franklin Allen, who used to be a Wharton, who's at Imperial College in London now. He's one of the experts on this stuff. And he basically said in capital regulation, there's a lot of argument. In liquidity regulation, there's so little agreement, we don't even know what to argue about. So what I'm going to do today is come up with the best take that Anil and I have on why you might regulate this stuff. And our framework is a bit different from the reasons you might have to regulate just something in general. You can imagine if there was like monopoly power, you might have to regulate certain utilities. If there was huge externalities, like air pollution or something, you might need to regulate carbon emissions. But we're going to give a somewhat different take for this regulating liquidity in the financial system. Okay, I'm going to come back to describe the two regulations that actually exist in a bit more detail when we actually go to evaluating them. But the two big things that are coming in around the world are the net stable funding ratio and the liquidity coverage ratio. In the United States, the liquidity coverage ratio is currently regulated, and it'll, as of January of this coming year, it'll be all the regulations will be completely kicked in. The second one, the net stable funding ratio, is in the process of being kicked in. So the net stable funding ratio basically says, measured over a 1-year horizon, you sort of have to match the liquidity of the assets to the stickiness or durability of the liabilities. What do I mean by a sticky or durable liability? How prone it is to going away in a crisis or in a run or in a panic. So if you have something that's infinite maturity, like equity, that really can't go away. They can't take their money out. If you think something like a checking account, a demand deposit, that could go away instantaneously. Some of those may stick around more than others. We'll talk about that in a few minutes. But the basic thing is that sort of you have to think in a broad sense how liquid are the assets, in another broad sense how persistent are the sources of funding, the liabilities, and staying around. And you measure them over a one-year horizon, and you're sort of supposed to have those things match up. The liquidity of the assets to the liquidity of the liabilities and persistence of the liabilities. Okay. From the point of view, what I'm going to talk about today is that this thing over the one-year horizon, it sort of has to hold most of the time, but at certain times, say crisis times, you would be allowed to violate the net stable funding ratio. You know, if you were in a crisis, you might be able to have some of your demand deposits, your short-term liabilities, go away, and as long as you had a plan to build them back up in time, you'd be allowed to actually, violate it. And if you had a certain amount of liquid assets on there that you had to use up to meet some withdrawals, you'd be allowed to do that. So this is liquidity that sort of you're allowed to use. In a pinch, you're allowed to run down your buffer of liquidity, so you don't have to start fire selling illiquid assets. Talk more about that in a minute. The second one is the one I'm going to talk more about today. That's the liquidity coverage ratio. So at all times, 100% of the time, you're supposed to have high-quality liquid assets bigger than some measure of what's an anticipated amount of outflow of deposits in 30 days of stress. So we're going to interpret that as saying during a run, think of like during the Northern Rocks run or during the run on Lehman Brothers. During such a period, people might be pulling funding away. You got to have enough high-quality liquid assets on the books to meet such a funding run. Okay. Now the point is, the liquidity that you still have to keep on the books after the run is already in process is liquidity that you're just not allowed to use. We're saying, what's the point of holding liquidity? So you can use it up if there's a crisis or a run. But if you're still required to hold a certain amount and you can't use it up, it looks like there's a paradox. So this gives rise to a well-known problem with liquidity requirements, and it's there's a quote I'll give you in just a second from Charles Goodhart, but I learned from Robert Hetzel, who's a Chicago PhD from the 1960s, that Milton Friedman used to tell this same story during his classes, and it's about the last taxicab at the train station. And here's the Goodhart version. The weary traveler who arrives at the railway station late at night and to his delight sees a taxi who could take him to his distant destination. He hails the taxi, but the taxi driver replies that he cannot take him since by local bylaws there must always remain one taxicab at the train station. So therefore you have this taxicab sitting there to make sure there's always one there, presumably so it can take you home, but if it's there and you can't use it, it just seems like a total waste. It seems like a very stupid idea. So in fact, I learned in the process of talking about this paper that there was such a law in France at one point. So this is not a good law. So I'm not going to speak about France here today or the political economy of this or anything, but there is something that seems wrong about this. There's this taxi that's sitting there that no one can ever use, which just seems like a waste of taxicabs. But what I will talk about in a minute is if you think a little more broadly about this, this could actually make some sense. It's not as stupid as it seems. So here's where we're going. This is the perspective of this framework. So most of the analysis, particularly the quantitative analysis that they ran in Basel, in the Basel committee to think about the Basel III stuff, the Basel III regulations, asks the question, how much liquidity do we need to get us through, if we're a bank or a financial system, through times of stress when funding is starting to go away? How much of a buffer do we need to weather the storm? Okay, so if you're thinking about this stuff as a buffer, liquidity that you're not allowed to use seems pretty stupid because you got a buffer you're not allowed to use. It seems like a waste. So that's not the view we're going to take. The view that I'm pushing today is that the point of requiring some liquidity that the bank or the financial system as a whole has to hold is to give incentives for the bank and financial system to hold liquidity in excess of the amount which is required. So you can think about how much is required that you can't use. You're going to say, okay, well, I can't use that amount of the liquidity. If I want some liquidity that I can actually use, I have to have more than the amount that is required. And we'll see that if you can give the bank an incentive, the banking system is incentive to hold excess liquidity over and above that's required, this can work to prevent runs from occurring in the first place, to deter a bank run. Think about the run on Lehman Brothers. Think about the run on Northern Rock. If everyone knew that those institutions had more liquidity than in fact people thought they did, it's quite possible that those runs that killed both institutions would not have occurred. And I'm going to argue that without certain types of regulation, it may be difficult to get banks to hold this amount of extra liquidity that's purely on the books to prevent a run from happening in the first place. So this stuff isn't a buffer. We're saying, okay, the buffer would be if people withdraw, that's how we fund it. This is saying if people know there's this extra liquidity there, certain people won't withdraw. Say, oh, this run is not going to bring Lehman Brothers down. I'm not going to try to get my relationship with Lehman broken. I'm not going to pull all my money out. I'm not going to ask for my CDS to be renovated to somebody else. So holding extra liquidity could have this nice consequence of preventing runs from happening. And we can see that requiring banks to hold more liquidity than they would choose on their own can actually lead to good things, potentially. Okay, so again, it's not a joke in this sense. Our point is this thing. A key goal of liquidity regulation to be providing incentives, not buffering, providing incentives to hold more liquidity than the required amount. And the point is going to be, relating back to this thing about taxicabs at the train station, that some of the liquidity that you're going to need to require them to hold to prevent runs is going to end up being unused because it sort of like it could have been used if there was a run, but because this extra liquidity prevented the run from happening in the first place, it's going to look like it's useless because it was, it's sort of like if you have a great inspection system to stop fires, well, you won't find any fires happening, but you're going to say, well, it's a really waste of money to have this inspection to stop fires. So there's going to be an analogy to that. Okay, so just give an overview of the sort of the model that we have in mind is some work I did back when I was in third grade with Philip Dybvig, who was in fourth grade at the time. So that basically it's just thinking about the answer of why banks write contracts which are subject to runs. So banks create liquidity, which are essentially short-term deposits, out of illiquid assets. They create liquid liabilities out of illiquid assets, and by allowing people to withdraw when they need their money in a hurry, and this works beautifully as long as everybody's sure it works beautifully and there are no runs. This doesn't work very well if everybody thinks there's going to be a run. So sort of the fear of fear itself, a panic, is part of the issue that short-term debt financial institutions face day to day. So the idea is bank deposits, you can withdraw them on demand, on no notice, think of like checking accounts, demand deposits, are more liquid than the assets the banks hold. If the banks tried to take all their commercial industrial loans and sell them 100% of them overnight, they'd get a really bad price, what's called a fire sale price. And those fire sales to finance everybody pulling their money out, if that was going to make the bank insolvent, then the fear of such a fire sale and the fear of such a run could be a self-fulfilling prophecy. Everybody thinks that everybody's going to pull their money out of the bank. That's going to kill the bank. So if you think everybody's pulling their money out, so should you. Okay, so banks, as long as there's not a run, can create liquid liabilities out of illiquid assets, but it leaves them subject to runs. Okay, here's why people care of just the last thing about Diamond Dybvig. People care about liquid assets is that either at the household level for consumption purposes or the firm level for uncertain timing of when they need cash to invest or fund certain shocks, certain unplanned needs for cash, that people are going to have some assets that they're going to need access to in a hurry to deal with those uncertain surprises. So we're going to have a 3-period model here. I'm actually going to present like an overview of the model that we use, a 3-period model. So people are going to put their money in at date 0. I'm going to talk about households rather than firms here. So a household, a person, is either going to need his or her money at date 1 or at date 2. As of date 0, they don't know which date they're going to need it for, but they're going to need it one day or the other, and they're going to need it in a hurry. If you find it on date 1, that you need it on date 1, you can't wait until date 2 and still do what you want to do with it. So we're going to imagine today is that they want to consume, but you could imagine, again, they would need to invest in something to keep their business running if it wasn't for households. And so everybody's going to want to put their money in date 0. They have the option to take all of it out on date 1 or date 2. And if everybody is sure that the bank who's going to do this, offer this option to take money out on either date, will stay solvent for sure, then only the people who really need their money at date 1 will take it out. And those who really don't need it until date 2 will leave it in, and then this thing will work beautifully. Okay, so here's some a little more detail. I'll talk about the deposits the banks offer in a minute. These are the assets they can invest in. They have a choice between 2 types of assets, illiquid loans and liquid assets. So if the bank invests $1 at date 0, it can invest in an illiquid loan, which if it holds it until maturity on date 2, returns some number bigger than 1. So R2 is the name for that number. So if you hold this loan to maturity, you get some high rate of return over 2 periods. But if you sell it or fire sell it or call it in early on date 1, you lose some money. You get less than 1. So you put $1 in at date 0. You have your choice, if you're the bank here, of liquidating the loan early for less than 1 or holding it to maturity and getting more than 1. Alternatively, you can hold some liquid assets where you put $1 in at date 0. You hold it for 1 period. You get R1 bigger than 1. And alternatively, if you don't need the money on date 1, you can roll it over. You can take the R1, invest it for another period, get R1 times R1, get R1 squared. And liquid assets do better over 1 period, and they're going to do worse over 2 periods. This R2, holding the loan to maturity, is going to be bigger than the R1 squared. Okay, so this is the issue of why liquidity matters. If you don't know when you're going to have to need the money, you're going to have to liquidate the loan, you're going to have a hard time deciding whether you should invest in illiquid assets or liquid assets. If you knew you needed your money for sure in 1 period, you'd invest in the liquid. If you knew you needed it until 2 periods, you'd invest in the illiquid. But if you don't know, it's risky. And what the Diamondific model does is sort of argue that there's a way the financial system can sort of pool this risk to allow more investment into illiquid assets and better access to liquidity than would exist without them. Okay, so the bank can create liquid assets, liquid liabilities, deposits out of illiquid assets, as long as the right people show up to avail themselves of the option. What that's going to mean? Everybody puts their money in the bank at date 0. The bank invests in some portfolio of illiquid and liquid assets. And if just the people who need their money at day 1, the people who are early, take them out, then we can invest just enough in the liquid assets to fund those withdrawals. We can leave all the rest into illiquid assets, and that'll work just beautifully. However, if everybody shows up to take their money out at date 1, runs, panics, that could make the bank fail. So if everybody shows up to take their money out at date 1, and the bank, let's say, put all their money into the illiquid asset, those are worth less than 1 at date 1. If the bank promised 1 or more, I'm going to assume they promised 1 to the people who withdraw. You can't give everybody 1 from a portfolio that's worth less than 1. So if the bank invested enough in illiquid assets, a run would bring them down. So the question is, today's question, which this framework is an answer to, is can we set up a banking system, a bank, that can survive what I'm going to call a partial run? which I'm going to argue based on data is the only type of run we ever see. Not everybody pulled their money out of Lehman Brothers before they failed. Not everybody pulled their money out of the Northern Rock Bank before they failed. There were runs on money market funds right in 2008. Not everybody pulled their money out of money market funds. A lot did. We'll argue it was particular types of types of firms that pulled them out. So if the bank is subject to a partial run, how much liquidity do they have to hold to make sure that partial run would never make them fail? If a partial run, which is the only type that might occur, would never make them fail, there'll never be a partial run in the first place because the people who are fearing fear itself said, oh, fear itself isn't so bad, it won't bring the bank down. Everybody else is pulling their money out, or some people are pulling their money out, I won't. Okay, so how many people, so let's build this up. We're getting into the weeds right now, but these are interesting weeds, so it's worth our time to get into them. How many depositors are going to need their money at date one? Okay, so a fraction T sub S, S is a little subscript to indicate the state of nature. That's going to mean T is not going to be, TS is going to be high sometimes, low other times, in the middle still other times. So a fraction TS, which is some number between 0 and 1, of depositors will need their money at date 1, and the rest won't. They'll need their money only at date 2. So, I mean, just to be concrete here, suppose there are 100 depositors and TS were 25. We say, okay, we know there are 100 depositors. 25 will be early, 75 will be late. It's not known which depositors will be early or late, but each depositor in this case, if they all knew it was TS was equal to 25, each depositor would have a 25% chance of needing his or her money early, 75% chance of needing it late. Okay, but the point of this is this TS, how many people are going to need their money for liquidity purposes in absent a run in a given period. That's not going to be constant over time. So some of the time it's going to be 25%, some of the time it's going to be 40%. We could, and that's going to be important to the story I'm telling, that you don't know exactly how many normal withdrawals for liquidity purposes, not panic purposes, not run purposes, a given bank's going to face. Okay, so that's going to be the essential. Our whole story becomes very simple and trivial if everybody knew that this number TS was always and everywhere 25%. Okay, so let's just put what I told you before back on one slide. We have a liquid asset that the bank has two assets it can invest in: liquid asset and a loan asset. You put $1 in at date 0, you get R1 or R1 squared for the liquid asset. You get theta R2 less than 1 or R2 bigger than R squared if you hold it to maturity. So over the long run, the illiquid asset, the loan is better. Over the short run, the liquid asset is better. Let's imagine you put $1 into the bank for deposits. You have the option to take $1 out at date 1 or $1 out at date 2. Paper doesn't assume that, just keeps things a little simple here. So obviously, if you promise everybody 1 and you invested the whole thing in loans, a run would bring you down because you got a portfolio that's worth less than 1 if you liquidate it. You promised everybody 1. If everybody pulled their money out or enough people were thought to pull their money out, that would cause a panic. Everybody would pull their money out. Okay, just the timing again. At date 0, the bank invests either in loans or safe assets funded by those deposits. On date 1, a fraction TS of people will want to withdraw. Here's the thing about the partial runs. Another fraction delta of people who don't really want to withdraw will think, or at least entertain thinking, they'll think that others are going to want to withdraw. So I'll tell you who these guys are in a minute. So there's some fraction delta of people who are potentially nervous about a run. They'll see Lehman Brothers is in trouble. They'll see they're having funding problems at the Northern Rock in the United Kingdom. And they're going to say, oh, they have funding problems. Does that mean I should get my money out? And the answer is going to be, if these people, this fraction delta of the people, think that those funding problems could bring the bank down, they'll pull it out. Other people, the people who aren't the fraction TS of people who need their money and aren't the fraction delta of the people who are freaking out about other people freaking out, those others, the 1 minus TS minus delta people, those people are like blissfully unaware. They're like retail depositors, or you can think of it, those are like people who have insured deposits. Even the United Kingdom had small amount of deposit insurance during the Northern Rock run. So we'll talk about these delta people here. So just reviewing a fraction, TS of depositors will want to withdraw. TS varies, and it's known only by the bank. Sometimes it's 25%, sometimes it's 40%, sometimes it's another number. Okay. Again, a fraction delta less than 1 of depositors see a report that I'm going to call it a sunspot in a minute that can make them expect others to run. This is like Lehman Brothers is having trouble. The Northern Rock is having funding issues, which we've heard. The Reserve Primary Fund, which is the money market fund that broke the buck and started the run on other money market funds in 2008. If you hold another money market fund, you found out that the Reserve Primary Fund broke the buck. Oh my God, I better get my money out of the Putnam Fund. Putnam was the second fund to be run after Reserve Primary. And they didn't go out of business as a result of their run. So what is this delta? I said I'd explain what the delta is. Delta is a measure of how run prone, which is sometimes called how hot is the money. So really what delta, the fraction delta of the people are holdings by institutional investors. So one of the interesting facts about money market fund runs, some work by Lawrence Schmidt from the economics department here and some co-authors showed that essentially all of the runs on money market funds in the United States in 2008 were institutional investors holding institutional money market funds. It wasn't you or me, it was some corporate treasurer who basically said, oh, I think there might be a run on the Putnam money market fund. I'm getting my money out of there before this makes them break the buck and make me lose some money. Okay? So not everybody is subject to a run, and in practice, when you've seen runs on financial institutions historically, it's not like, gee, everybody took their money out yesterday, which made them fail. Like, gee, 35% of the people took their money out, the rest left it in, and the question is, if people fearing 35% of the money being pulled out could make them fail, then this fear of fear itself by those potentially freaking out 35% is an issue. If we know that no more than 35% of their money would freak out and pull their money out, then there's going to be 35% of the people who will be able to rest easy and not panic. So runs are only from the institutional investors, say only from the hot money, and they're going to be partial. TS, the number of people who need their money just because they need it, plus the guys who might freak out, delta, TS plus delta is going to be less than 1. So the runs here, unlike the Diamond Divig thing that I mentioned from the 80s, the runs here are partial runs based on the idea that only institutional investors, or if we thought about deposit insurance, only uninsured depositors are going to run. So you'd say, well, look, if the government is good for it, so let's say it's the US government rather than the Greek government, if the deposit insurer is good for the money, if you think everybody's going to pull their money out of the bank, you're going to say, well, I don't really care. The government's going to pay me off anyway. There may be, okay, so that's what I'll say. So, and here's what I'm going to claim, and I'll sort of give you a sense of why it's true. If you want to make this bank that I'm going to talk about that could hold the liquid assets, the illiquid assets, and the deposits that give the option to take the money out early or late, if you want to make them run free, what does that mean in practice? In detail, that means we have to make sure they're liquid enough, they hold enough liquidity, so if the TS plus delta of the people show up to withdraw, TS who just need it, the delta who are freaking out because something has caused them to think that others are freaking out, there's a panic, they have to hold enough liquidity so if TS plus delta depositors show up, the bank will stay solvent. So if you thought the other TS plus delta guys were going to pull their money out, you'd have no reason to pull your money out if you didn't really have need for money at day one. You wouldn't join a run just because you thought it was going to happen. If the bank's going to stay solvent during a run, you don't care if there's a run. I mean, the bank may care, but you're not going to lose any money leaving your money in. So if your corporate treasurer goes, yep, I know this other corporate treasurer is likely to pull his or her money out. I'm not joining in. So if the bank holds some extra liquidity over and above some amount I'll talk about in a second, then this fear of fear itself partial run can never occur. That's going to be the point. If you hold some extra liquidity over and above what you need to meet normal withdrawals, and people know that, then they won't particularly think that just fire selling assets to meet unanticipated withdrawals could ever make the institution fail. So once they're and again, I sort of this is the point I'm going to be trying to make about extra taxi cabs at the train station. You hold some extra liquidity to prevent delta guys from panicking and withdrawing. Once you hold some extra liquidity, those delta guys won't withdraw. So now you see some liquidity on the books. Why do you have this liquidity on the books period after period that you never use? Well, the point is if you have some liquidity on the books period after period that you never use, you don't get any runs. And if you didn't have that liquidity, you would have needed it. Okay, so that's the point. It's the deterrence effect of extra liquidity that says there are going to have to be some extra taxi cabs at the train station. If you look at the data, you're going to see, hey, banks are holding liquidity every period. They're not using it in almost every period. It's like taxi cabs that just sit there without a law, period by period, sitting at the train station waiting for someone to come. Okay? So it doesn't seem like doesn't seem like there's any particular reason that the government has to regulate anything to do this. So suppose everybody understood this idea that we need some extra liquidity to deter runs. People wanted banks that were run-free, which I think is a good assumption. Then it seems like if the bank could just disclose to the public and say, look, I've got enough liquidity in my books to prevent a run from occurring. I'm a safe bank. Come to me. Don't go to that bank over there that doesn't have enough liquidity. They're subject to a run. Come to my bank, which has the extra amount of liquidity needed to prevent runs. It would seem like just the invisible hand, just market forces would force banks to hold enough liquidity to make themselves run free. Just disclosure should do it. So we're going to I'm going to give you three arguments, one of which is the model that Neil and I have, the other two which are almost the same idea, that basically says simple disclosure of how much liquidity you have is not necessarily going to solve the problem in the cheapest possible way. Okay, so what we're going to argue is that bank has private information that the public and the regulators don't have about their time-varying, or if you think about across banks, bank-varying needs for liquidity. That's going to be this TS. How many deposits will be withdrawn for normal, non-run reasons, non-freaking out reasons? So sometimes it's 25%, sometimes it's 40%. So if you see a certain amount of liquidity on a bank's books, you don't know if that's a lot or a little. It's a lot if only 25% of the people are going to withdraw. It's only a little bit if 40% of the people are going to withdraw. So that's what I'm going to give you a little sense of a model for. But two closely related things, one of which I'll show you some data for, is that if you just release, let's say, how much liquidity the bank has on its books on the end of the year, December 31st, and let's say you only have to do that once a year or once a quarter, that may not tell you as a depositor, a potential running depositor of a bank, how much liquidity they have on January 3rd or January 10th or March 15th. Okay, so periodic snapshots aren't necessarily going to be good enough because the bank can easily window dress. And I'll show you some evidence for window dressing in a second. The last one is, suppose the bank just had to disclose how much liquidity it had every single day. Well, suppose it sort of used up its liquidity. You're going to say, well, we used to have a lot of liquidity, but to make sure there weren't any runs, we used it all. Guess what's going to happen? The run comes today rather than yesterday. And something like this happened in the United Kingdom during the crisis. So in the United Kingdom, they have lender of last resort. You can borrow money from the Bank of England if you're a bank. You can use that liquidity you borrow from the Bank of England to prevent a run or to stop a run from bringing you down and fire selling assets. So what happened? they don't disclose which bank borrowed, but they disclose the total amount of borrowing periodically from the Bank of England. So during the crisis, the Bank of England disclosed that there was a very big jump in the amount of borrowing from the Bank of England. And then that was public, so various financial analysts called all the big banks. And all but one of the banks said, not me, not me, not me. And Barclays Bank said, no comment. And then if everybody's telling the truth, they just confessed that they were the one that borrowed, and that actually caused some funding issues. It did not bring them down. They were quite solvent bank. But disclosure has its own issues when you're talking about panics. Just end of the year disclosure also has its own issues. This is some data from a paper by Benjamin Munyon that shows the outstanding quantity of tri-party repurchase agreements on the books of European banks at the various dates. So European banks only have to disclose their amount of repurchase agreements they have outstanding on the end of the quarter. So if you look at it, at the end of every quarter, the number of repurchase agreements plummets, goes way down. So they can report, gee, we don't rely on repo funding hardly at all, except for all but 4 days a year we do. But on those 4 days where it's all out in the open, we just disclose that we don't have much. This is nothing like, if you know about the Repo 105 thing of Lehman Brothers, this is nothing like that. They're not doing anything completely misleading. They're just making things, they're doing what's called window dressing. They're making things look good on the disclosure dates. Doesn't tell you much about the non-disclosure dates. It just spikes down on the disclosure dates. So these runnable liabilities are not just checking accounts. If we look at, this is from some data by the Federal Reserve Bank of New York that show there's still plenty of runnable liabilities around. And if we look, let's say it's a fraction of nominal GDP, we see even today, runnable liabilities are around 60% of nominal GDP. Right before the crisis, they were up to around 85%. Some of that ran off during the crisis, literally ran off. And so this idea of liquidity risk still being an important part of the US financial system is a big deal. Okay, I'm just going to quickly go through how the model works. Okay, so the bank has to choose how much to put in these liquid assets, how much to put in illiquid assets. Alpha is the fraction that goes into liquid. 1 minus alpha goes into the loans, the illiquid. And the bank, if it knows how many people are going to withdraw, let's say 41% are going to withdraw, will find it in its interest to have enough liquid assets to fund all of those withdrawals. So if 41% of the people are going to withdraw, you put enough into liquid assets to exactly fund that. Why put money into something that you put $1 in and get less than $1 out, for sure, when you can have something else that puts $1 in and gets at least $1 out, more than $1 out. So if you knew exactly how many withdrawals are going to occur, the bank would be perfectly incentivized to hold enough liquidity. So I call that automatically incentive compatible, which just means it's automatically in the bank's interest to have the right liquidity holdings to meet the actual number of withdrawals. However, the bank knows TS, the number of people who need their money absent a run, but the number of actual withdrawals, which I call F1, will either be TS if there's not a run, or it'll be TS plus delta if there is. So if delta was 0, if there weren't any runs, the banks would always just hold the right amount of liquidity. Okay, so so you wouldn't need to regulate or disclose anything. The bank, just self-interest would keep the banks on the right amount. So this is just this line. If 20% of the people can withdraw, that's how much liquidity you hold. If 40%, you hold a bigger amount. If 60% are going to withdraw, you hold a bigger amount. That's the automatically incentive compatible amount. If you knew there were never going to be runs, if T was going to be low, you'd hold a low amount of liquid assets. If T was going to be high, you'd hold a larger amount of liquid assets. Now the tricky thing is that it's also possible that there's a run. An extra fraction delta of the people might withdraw. So if TS plus delta of the people withdraw, to fund those withdrawals, you'd have to have this much into liquid assets. If nobody withdrew, if there wasn't a panic, there wasn't a run, only this number would we withdraw. So the question is, does bank self-interest give the bank if you can't exactly tell if it's the right amount of liquidity, because it's hard to measure, as I mentioned before, to hold this extra amount of liquidity that would keep them solvent for sure versus not. Okay? So will the bank choose enough liquidity so that it's run free? And the answer is it depends. So this is just for a numerical example of this model. So this gold line, the AIC thing, the automatically incentive compatible, this is the amount of liquidity that the bank would hold just to meet the normal withdrawals absent a run. This blue line is the amount of they'd have to put into liquid assets to make sure they stayed stable, stayed solvent, even during the run of TS plus delta. So for the example with here, if like nobody was, if this is TS down here, if nobody was going to withdraw in normal circumstances, and they just put the whole damn thing in illiquid assets, if 0 plus delta people showed up, delta's 0.3 here, they'd still stay solvent. So that even if they held the automatically incentive compatible amount, they'd be stable. But let's say 40% of the people was the normal amount. If they only put this number here to fund 40% of withdrawals, and 70% showed up, 40 plus 30, they would actually have needed to put more into liquid assets to stay solvent. So for this just shows that the amount of liquidity that they need to stay stable may exceed the amount they need for normal withdrawals. If you knew this and you could measure everything exactly, this wouldn't be a problem. But because you as an outsider or a regulator don't know what TS is, the question is, can you make sure that the bank has an incentive to stay with this extra liquidity rather than this just amount to meet normal withdrawals? Okay, taxicabs. Once the blue line is above the gold line, and they have to have more liquidity than they would need to meet normal withdrawals, after those normal withdrawals occur, which was what will happen if there's not a run, if there's not a panic, there's going to be some unused liquidity down here that they carry not just from date 0 to 1, but they carry from date 1 to date 2. These are taxicabs that sit in the train station all the time. This is the unused liquidity, which is just the difference between these two lines. Okay, so stability is going to usually require some unused liquidity. So just simply requiring the bank to hold some extra unused liquidity solve the problem? This problem here is how much liquidity would they have to hold in addition to meeting normal withdrawals so that they would stay solvent in a run, even if the run occurred, assuming that all that liquidity could be used to meet withdrawals from a run. They could just use up their required liquidity. There were no taxicabs required at the train station. They could release them all. But if the regulator doesn't know what TS is, how many normal withdrawals are going to be there, the regulator can't say, you have to hold some extra liquidity, but during a run, you're allowed to use it. Because we don't know whether a run is occurring if we're a regulator or just a person. Why? Because let's say you see this many people withdraw. It could be this is what TS is, or it could be this lower number is TS, and there was TS plus delta withdrawing. So you see a lot of money pouring out of the bank. One of two things is true. Either a lot of people just needed their money today, or only a moderate number needed their money today, and there was a run going on. So you can't just release all the liquidity because as a function of the number of actual withdrawals. If the number of actual withdrawals doesn't tell you whether there's a run going on. Okay, so that's basically our model. We can use this model, and I'm only going to do it at a really high level, to evaluate the two Basel regulations, and then I'm going to show you that we can actually do better than the two Basel regulations. Okay, so I mentioned the two Basel regulations that I'm going to evaluate. The net stable funding ratio, which is the way we're going to interpret here. We're taking a little bit of liberty here because it doesn't actually say this in the requirement, is that there's a certain amount of liquidity you have to hold. It's just money that you have to put into liquid assets in normal times, but you're free to use it for a while, and you can violate it for a period. This is going to mean, in the way we're modeling it, you can just use it. If you need that liquidity at date 1, you can run it down to 0. Whereas the liquidity coverage ratio is a certain amount of high-quality liquid assets relative to something that you always have to hold. This is unusable liquidity. It's going to be a fraction of your remaining deposits. Okay? So here's what happens. The net stable funding ratio which is something which is liquidity you can always use. No requirement in the future that you continue to have to hold it. The only way to make the bank run free here is to make sure the bank is run free in the worst case scenario. And the worst case scenario is the T upper bar. That's the worst, the highest T. So this is the worst case scenario. This is how much liquidity you'd have to hold to stay stable in the worst case scenario. The net stable funding ratio will only work if you require this huge amount of liquidity. Why? So think about that. What's a panic? I'm thinking of panicking. I'm a corporate treasurer. I'm thinking all the other corporate treasurers are freaking out and going to pull their money out. Neither I nor the other corporate treasurers know what TS is. So I'm going to say, well, what's the worst case? I'm thinking of them panicking. What's the worst case I think they might be thinking? Well, the worst case they might be thinking is this case, the worst case here. So if I think everybody else is saying, worst case scenario, should I panic? If the answer is yes, then everybody is going to withdraw for any amount of liquidity below this huge amount here. And even for the low levels of TS, let's say 40% or 20%, I don't know whether it's 40% or 20%. I think there's going to be a run because I think others in the worst case scenario think there's going to be a run. So unless you hold this much liquidity, it turns out you can show that not only would there be a run in the worst case scenario, there would always be a run. Okay, so that's not good. So that's no taxicabs required at the train station. Let's do the liquidity coverage ratio. Liquidity coverage ratio basically says at all times, the liquidity has to be a fraction of remaining deposits. So F1 is the number of actual withdrawals at date one. F1 is either TS, the normal withdrawals, or it's TS plus delta, the normal withdrawals plus the other freaking out corporate treasurers who panic. So the liquidity coverage ratio says at all dates, including from the middle date to the end date, which is all the time, you have to hold a certain amount of liquidity. So the interesting thing is, if you hold enough liquidity to stop the run from occurring, which is how we're going to parameterize this, one thing you could say is if everybody withdrew at date one, 100% of the people withdrew at date one, you don't have to hold any liquidity. If there are no deposits left, you don't have to hold any liquidity. If nobody withdrew, you have to hold a fraction rho of liquidity. So if 1 minus F1 was 0, you don't have to hold any. If 1 minus F1 was 1, you'd have to hold rho. And as more and more withdrawals occur, more and more liquidity gets released. So here's an interesting thing we can look at. Here's an example. So to keep it stable with a net stable funding ratio, you have to hold about 80%, 75% of your assets into liquid. Here, let's imagine that the actual TS today was 0. You'd only have to hold about 57% of your assets in liquid assets. So here's an example, like for TS equals 0, where the liquidity coverage ratio that makes you hold 60% of your assets from sitting at the train station completely unused from date 1 to date 2 is better than the best regulation that says you can use all your assets to meet run, but you have to cover the worst case scenario. Why is it going to work? If the bank knows that only 0% are going to withdraw normally, they're going to hold exactly this amount of liquidity just to cover the requirement that they have liquidity, and plus an extra 0 of normal withdrawals. That is still going to lead to more lending than the net stable funding ratio. So if we actually add in for the various levels of TS, if nobody was going to withdraw, TS is equal to 0, they'd hold about 57% of the assets. If they knew TS upper bar were going to withdraw, they'd hold exactly the same amount they had for the net stable funding ratio. And for anything in between, they hold less liquidity. Less liquidity means more lending, which is what we want to do in the first place. So this shows that requiring taxicabs to stay at the train station is a sort of a function of the number of trains remaining to come in actually works better. Half the trains have come in for the day, half the taxicabs can go. After the last train has come in, that last taxicab can go. So there must be excess liquidity. All the regulator has to do is measure how much is left after withdrawals occur. There's still going to be, after normal withdrawals occur, if you hold enough so there's not going to be a run, there's going to be some extra liquidity to keep the bank run free in the first place. The last taxicab must not leave. If the regulator doesn't have to know if, let's say, 71% of the deposits withdrew, they don't have to know that's because of a run or not. They just say, okay, 1 minus F1, multiply that by rho. That's how much liquidity there has to be. That'll make the bank run free. Okay, so that shows that if the bank has enough private information, if there's enough volatility in how much TS is, how much normal liquidity they need, then something like the liquidity coverage ratio, which requires some unusable liquidity to give incentive to hold more than that, can do better. Okay, we can even do better than this, and I'll just give you a sense of it, then I'll stop. So we could even do better. This is the last part of the paper, how we could do better than either one. So the best regulation, which requires less liquidity even than the LCR, can be implemented by combining lender of last resort, like the Federal Reserve discount window, with liquidity regulation. So basically, require the bank to hold the amount of unused liquidity that would be required if you could tell, if the regulator could tell whether it was a run or not. Okay, I argue that that wouldn't necessarily work. That would only work if the bank was free to run that liquidity down. If they were free to run that liquidity down, they wouldn't hold enough. So the way to do it is say, require this amount of liquidity, but you're allowed to use it. But if you use it, there's a huge penalty imposed on the bank for using it. Now, if it was a penalty of like you charge them a huge penalty rate, like Badgett talked about, if you know of, there's this thing about lend freely at a penalty rate. Set a penalty rate that makes the bank insolvent if it used it. That would sort of be pretty stupid because that would make the bank fail and they'd have to use it all the time. So basically, you need a penalty rate that doesn't make the bank insolvent. So if you require a certain amount of liquidity, you violate it. What you do is the discount window, the Federal Reserve discount window, lends against the liquidity. Normally you think about lending against illiquid assets. Lend against the liquidity and drive the banker's compensation to zero. Either if it's an owner-managed bank, that's like dividends. Otherwise, you drive executive comp to zero and dividends to zero. So this is like saying, how do you get enough taxicabs at the train station? Said, if you ever use that last taxicab, put a penalty on the taxicab company. And they can decide whether they want to let that taxicab go or not. And if we're concerned about runs on taxicabs, I don't have time to talk about those. Right now, it's getting off at the previous station because you thought there's going to be none at your station. If you keep extra taxicabs there, subject to this penalty, you can do better. So this is not a new result. They knew this in the 19-teens. The original Federal Reserve Act, it's no longer in there, it got removed, had a dividend prohibition for violating your reserve requirement. The original liquidity requirement was the reserve requirement. You had to keep a certain amount of your assets in reserves held at the Federal Reserve. You were allowed to violate your reserve requirement. Just like we're saying here, you're allowed to violate your liquidity requirement. But whenever you're violating your liquidity requirement, you can't pay any dividends. That's exactly why this is better. So this is essentially makes it work better here, is that essentially lender of last resort policies and liquidity regulations ought to be integrated by allowing fewer taxicabs to be wasted. And the idea is you get them to hold some liquidity, they're allowed to use it, but when they actually use it, they regret it. So if you make the regret big enough, they won't actually use it, but they'll have it there, which they could use. That stuff that they have there that they could use stops the run from occurring, because everybody knows, well, they could use it. So they hold more liquidity than they need. They're free to use it all, but they actually leave those taxicabs sitting there to avoid the penalty, which in this case is the dividend restriction. So simply disclosing isn't enough. Liquidity regulation can correct this. Got to leave some taxicabs to the train station. We ought to think about integrating liquidity regulation with lender of last resort policy. That's what I have to say. I wonder if there are any questions.
Is there any concern that banks might try to work around the dividend prohibition, or like the dividend prohibition might not really hurt the bank that much if they can sort of say, okay, well, we can't pay dividends this period, but that's actually not that bad for our investors because we just pay those dividends out next period?
Well, there's two issues here. So I think in the days of the original Federal Reserve Act, most of the banks were actually closely held. So the shareholders and the managers were more or less the same people. So essentially what that's going to say is that you can't pay any dividends while you're violating your liquidity coverage ratio, your reserve requirement. So if you sort of disclosed that you weren't allowed to actually, you had to cut your dividend to zero, say, that conceivably would be sufficiently embarrassing for the bank that it might cause people to think they were having funding troubles, which could cause the run to work as a discipline device. So that's one possibility. They can work a little bit like the Barclays Bank. That, in fact, presented this to some bank regulators. They said, well, that's good in principle, but if you imagined you actually told a bank to cut their dividend to zero because they'd violated their liquidity ratio, that dividend cut would reveal that there was some kind of bad thing going on in the bank, and that would bring it down. So the idea would be that the reluctance of banks to publicly cut their dividend from whatever it was to zero might work as a sort of a implicit penalty to make it work. But you're right. If we really thought about this in a sense that we want the managers of the banks and the stockholders of the bank to care about it, you'd have to do something to cut executive compensation as well as dividends to make it unprofitable to plan to violate your liquidity requirement. But that's a good question.
Hi, how does this compare to the Anatomati's suggestion to, instead of having banks funded by deposits, instead having them funded by purely equity, like you said earlier?
Okay. So that's like the extreme version of the liquidity coverage ratio.
Sure.
I'm sorry, that's the extreme version of the net stable funding ratio. So essentially what you have to do is, that would say, I'll tell you the answer, then I'll tell you why. The answer is, if the bank assets are sufficiently close to being liquid, if that theta times R2, which is the fire sale value of the illiquid asset at date 1, if that number is pretty close to 1, if they're only a little bit illiquid, then capital requirements work pretty well. And I'll tell you why when it's done. If that number is real close to 0, let's say the assets are really illiquid, so if it's worth R2 if you hold it to maturity, it's worth theta R2 if you fire sell it at date 1. If that number is close to 0, then capital requirements don't work at all. If that number is literally 0, then capital requirements don't work. Here's how capital requirements could be thought of in this setup. We want to think about requiring the bank to fund itself with enough equity to keep itself run-free, as well as fluctuation risk failure-free. We want to try to keep the amount of deposits that the bank provides in liquidity to the financial system constant. So what we do is we keep the amount of deposits constant. How would a capital requirement work? Say, okay, you've got to raise, in addition to these deposits, raise some extra equity, long-term liabilities, invest them into illiquid assets, and use the collateral value of the fire sale collateral value of the illiquid assets funded by stable long-term funding to make sure the bank stayed solvent during a run. So I don't know if you followed that. So that there's two ways to think about what a capital requirement could do. You could say, I could just have fewer deposits and more equity, or I could say I could have the same number of deposits and more equity and more assets. So the first thing, fewer deposits and more equity, holds the size of the balance sheet constant. The one I'm proposing is keep the amount of deposits constant if deposits are useful. Say, okay, useful deposits, more liabilities and more assets, bigger banking sector. I think that actually is the way that Admati and Hellwig think about these things as well. You know, what's the best way to think about why capital could be good? If you think about that, if theta times R0, theta times R2, the fire sale value of the long-term asset, is close to 0, any finite number of extra liabilities to put into illiquid assets wouldn't work because it wouldn't provide any collateral value. So the idea is if you want to solve this problem via capital requirements rather than liquidity requirements, if the assets are super illiquid, you'd have to make the bank balance sheet 100 times bigger. If they're super liquid, you might have to make it 5% bigger. So if it's only making the bank's balance sheet 5% bigger sounds like a nice solution. Making it 500% bigger may not be such a nice solution. So if liquidity is the problem, fix it with liquidity. If it's pretty close to liquid in the first place, you can fix it via stable funding. That's so, you know, it's empirical question of how which is the cheapest way to solve this problem.
You made the argument that people might not know how many more people are going to withdraw their deposits. So in that case, so would you suggest products such as the COCO bond helpful in this case so that it will automatically adjust? Although in that case, it would be maybe more relevant for solvency, but in a similar rationale, would you suggest these kind of products?
It's actually closely related to the question I just talked about on capital. So CoCo bonds, these are, if you weren't here for Mark Flannery's talk a few weeks ago, CoCo bonds are bonds, debt that converts into equity or maybe writes down to zero as a function of the value, the book value of equity in the bank. And it's a way of sort of automatically recapitalizing banks when they get somewhat close to insolvency. So that is basically a fancier version of more capital. It's more contingent capital rather than just more uncontingent capital. So that only works well if the assets that the bank, the illiquid assets that the bank invests in, the loans, are already pretty close to being liquid. If they're pretty close to being liquid, then just like equity works well, contingent capital works even better. Contingent capital, like these requirements that Kashyap and I are talking about here, are set up to provide incentives to have the bank to change the bank's actions. CoCos, like Mark Flannery's view, my view, a lot of people's view, people who like CoCos think of them as providing incentives to change the bank's behavior. The liquidity coverage ratio, or this generalized thing that integrates the liquidity coverage ratio with lender of last resort policy, are designed to change the bank's incentives to hold liquidity. So I like CoCos, but I don't think CoCos are the right answer to solve the liquidity problem. They're not. You'd want to have some mix of CoCos, equity requirements, and liquidity requirements. Last thing on CoCos, you can think of CoCos as equivalent to ways of telling the bank, if you get a little bit undercapitalized, you have to raise some more equity in a hurry, and you can't run your capital buffer down to zero. Just like you can't run your liquidity buffer down to zero in the stuff I'm talking about here. So CoCos are a way of pre-financing the automatic recapitalization of a bank as it's losing some money. That's great for incentives. So CoCos are good. They solve many problems, but liquidity requirements may be good at the same time. It's like we're done. Great. Well, thank you very much.